I was asked by someone during retirement whether they should be buying bonds. I am not an investment advisor, so I cannot answer that question. Even if I was an investment advisor, I do not have the kind of information that would be needed to even form a preliminary opinion on that kind of subject. Investors need to answer that kind of question for themselves or in consultation with a trusted financial advisor, taking into account their goals and what needs to be done to meet them, their unique situational risk and risk tolerances. I can only make that judgment about myself and family members and no one else. Situational risk is broadly defined by me as to include expenses during retirement, saving to buy a first home, college education for the kids, and such things. I can provide a general framework for someone thinking about what considerations go into the decision-making process on making asset allocations as one ages. The first consideration is an informed and reasonable estimate as to how much money will be needed to meet your financial goals. And that will largely govern how much risk is necessary to meet those goals. Most people only have a relatively short time in their earning career where they're making enough money that they can put aside to have a chance to meet the financial goals later in life when they retire. One expense in retirement is health care. Fidelity has an estimate that you can find on the internet where they claim that a person who is age 65 in 2023 would need $157,500 in savings to pay just health care costs during their retirement. A couple would need $315,000. So that's a large chunk of money just for health care there. The goals may include, as I said, college education for children. I saw that Vanderbilt just went over $100,000 all in. When I started college, the all-in cost, which included tuition, board, and everything else that goes with it, was $2,200. Some people will be needing to save to buy a new home, but my focus here and for myself also is just the retirement expenses and planning for that. I retired with no debt. I own everything free and clear. That clears my mind of concerns about what I can do with my capital after living expenses. I've not yet had to dip into my principal amount of my capital. I've been able to live off interest and dividend income. I would emphasize that where you need to get to will largely define how much risk will be necessary to assume in order to have a chance to get there. I refer to my treasury bill and short-term corporate bond investments as just running in place, where I place primary emphasis on capital preservation with income generation, hopefully in excess of the inflation rate being important. Savers know that due to the jihad that the Fed undertook against the savers in the United States for almost 20 years now, up to 2022, suppressed interest rates below the inflation rate, so the real negative return before taxes for savings, risk-free savings, was less than zero. Buying only treasury bills and bonds at the current yields will not meet most Americans' financial requirements. It may for the top 10% or even maybe only the top 5%. At a 5% yield, it takes about 14.2 years for money to double before taxes and inflation adjustment. So that is more like a running in place option for investors, even with inflation running at 3% and the yields are over 5%, which is only happening within the last 6 months to a year. Has that been the case? Some mixture of bonds and stocks may be appropriate as the only way to meet the likely financial cost that one expects to incur. One thing to keep in mind, and this is important consideration that is based on history. I know young people think that stock market may go down for a little while and then come roaring back, and it's like putting money in a slot machine, and you know you're going to win the jackpot every time you do that. When I started to invest, and I didn't probably understand it fully then. It was the late 1960s, but the stock market was in a long-term bear market that was being caused by problematic inflation. That was the primary cause. I started in the late 1960s, so I have now lived through 3 catastrophic bear markets where the S&P 500 declined by over 45%. That will happen again, and I would prefer not to have a lot of money in stocks at my age when that happens. I might disturb my sleep some, and it will happen again. It's not a question of whether it will happen, but when and how many times in your lifetime it will happen. It has happened 3 times in my lifetime so far. I did not appreciate, as I said, that when I started to invest, and my first stock purchase was Hospital Corporation of America. I think it was in 1968 when it had one hospital in Nashville. I did not understand that stocks were in a long-term bear market. An investment in the S&P 500 on January 1st, 1966, and reinvesting the dividends would have had a negative 1.813% annual average total return adjusted for inflation through July 1982. That is 16 years and of negative annual average total returns adjusted for inflation with dividends reinvested. The period was much longer after the 1929 stock market crash, and there was another long period that started around the dot-com bust in 2020. Now, the granddaddy of the bond bear markets was also going on when I started to invest. I would date the long-term bear market in bonds as starting in 1950 and ending in 1982. So that was 32 years. The stock and bond asset classes both failed in the period from 1986 to the summer of 1982. And that's a long period for the 2 major asset classes to fail. So these bad things do happen. They will happen again. It's just a question of when. I made this observation in several posts. I've been talking about this kind of historical fact about past returns over long periods of time when they would not have met an investor's goals. I recently talked about it in my last blog, which was published on last Friday. And in that blog, I quoted from a May 29, 2009 post when I was responding to something that Professor Siegel had said about stocks. And I'm quoting from that 2009 post now. For an investor, 10 years is a very long time, and to have stocks fail as an asset class for a decade could easily be a major disruptive event in their lives. Siegel has yet to come to grips with that fact, that major averages are currently at levels last seen in 1998 after the spirited 34.3% rally in the S&P 500 off the low in early March 2009. Another problem with Siegel is that he fails to come to grips with the long periods when stocks fail as an asset class, and the importance of that failure to individuals who face really serious situational risk. That risk is extremely important to the vast majority of individual investors. It would include the risk, for example, of retiring soon after the start of a major bear market and having to depend on the stock portfolio to provide income. Then, during the bear market, stocks plummet over 50%, and corporations include most banks cut or eliminate their dividend, the primary source of income from stocks for individuals. That's end of quote. Another source is that they have to sell stocks in order to supplement their income necessary to meet their expenses, and they're having to do so when stocks are falling a lot in price, possibly even falling well below what they bought the stock for originally many years prior to that. So if I'm able to take less risk, which I'm now in a position to do, I will focus on de-risking my investment portfolio through a variety of means, including high weightings in treasury bills and short-term corporate bonds, and a significant allocation in high-yielding treasury money market funds. And I will reduce my stock risk through a variety of measures that I talk about in my blog routinely.